You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 22nd of July 2025, and I'm joined today by my co-host John McEwen. In this week's episode, we'll be discussing Halma, Diageo, cbox Holdings, Frasers Group, Mony Group, and our US company of the week is Verizon. John, should I start off with Halma?
Yeah, how are they doing?
So, well, it's been a while since we've covered them, so I'll just give a recap for anyone who didn't listen or doesn't remember from last time. So, Halma are UK listed global group of technology companies which specialise in products for hazard detection, life protection, healthcare, and environmental monitoring. The group's business model is based on acquiring, growing, and actively managing a highly diversified portfolio of small to medium-sized technology companies. They've got three main divisions: safety, which is technologies for fire detection, industrial safety and security; environmental and analysis, which is environmental and analytical monitoring technologies, so stuff like water quality, air monitoring, and stuff like that. And they've got the medical side, which is for enhancing patient care and healthcare quality, so stuff like diagnostic devices, eye care, fluidic components for medical machines. In terms of revenue, pretty well diversified, but 42% of the revenue last year came from the US, 20% European, 15% UK, 15% Asia Pacific, 4% Africa and the Middle East, and 4% other. So they have come out with their full year results, and full year organic revenue grew 9%, ignoring currency impacts, to £2.2 billion. Underlying operating profit grew 13% to £486.3 million, which was ahead of expectations. They completed 7 acquisitions in the year with a maximum consideration of £157 million. Net debt, including leases, improved by £117 million to £535.8 million, or 0.97x times cash profits / EBITDA. I think that's a pretty reasonable level and pretty manageable. Due to higher profits and efficient cash management, free cash flow rose from 435 to 545 million. The new year has made a positive start, and Halma is aiming to deliver upper single-digit organic revenue growth in the coming year. Underlying operating profit is expected to be modestly above 21%, with the usual target range being 19 to 23%. The final dividend was up 7% for the year, and the shares were up 8% following the results. The results were mainly better than expected, which was largely due to actually one subsidiary that they had, but it plays a critical role in AI data centers. So I suppose that probably expect that to continue, given that I don't think the AI craze has gone away. This is also the 22nd consecutive year of profit growth and the company's 46th year of a 5% or higher dividend increase. In terms of valuation, business trades at a forward PE of 30, and that's basically on the 10-year average. Prospective yield is 0.8%, and that compares to a 10-year average of 1.1%. I thought these results were excellent. I think you could argue they got a bit lucky with the AI business, but the results themselves are great. I think organic revenue growth of 9% is excellent, especially when it seems to have been more of an acquisition strategy to grow the business previously. So to get the organic growth as well, I think is absolutely excellent. That being said, I would assume that the revenue is going to slow at some point from the AI side, and I think they're going to go back to being dependent on acquisitions for it. But for me, I think it looks like a pretty high quality business, but I just wouldn't pay 30 times earnings for it. What about you, John?
Yeah, I think 30 times earnings is the difficulty. I was actually looking at their list of brands, and they have Keeler, which is one of the medical equipment, and I actually have a Keeler ophthalmoscope and otoscope, which was interesting. But I think the brands, actually, when you look at them, some of them are pretty decent. I think they're also really quite niche and diversified as well. So I think there's a good, core group there, which probably makes them fairly resilient. However, I guess that the concern is that it's not huge organic growth that it's historically been delivered. Yes, its management seems to be doing a fantastic job and acquiring, making good acquisitions, I suppose. But that those couple of things would probably be my concern. And yeah, at 30 times earnings, it is a lot.
Right then, should we move on to a cheaper business?
Yes, well, it's been quite an expensive business, but as of the last couple of years, it's come down an awful lot in value. So Diageo, they haven't actually had any results out, but the big news was that their chief executive has stepped down with immediate effect and by mutual agreement last week, and the comprehensive formal search process has begun, which will include internal and external candidates. The chief financial officer will assume the role on interim basis until a permanent appointment has been made. And Deborah Crew, who is the outgoing chief executive, stepped in June 2023, so almost exactly 2 years ago, after the sudden death of the long-time chief executive Ivan Menendez. And having joined the company as a non-executive director in 2019 and later serving as the president of Diageo North America, she was then promoted to group CEO. The group have said that guidance for fiscal 2025-2026 remains unchanged from the third quarter trading statement in May, and full year results will come out on the 5th of August as planned. The shares initially were up around 2%, and then they petered back and closed up about 0.4%. In terms of the group's valuation at the moment, so it's got a market cap of 42 billion. So it is very big and trades at 15 times forward earnings compared with a 10-year average of 21, and has a prospective dividend yield now of 4.1%, so higher than it's been for a long time. I suppose one of the questions for Diageo is that obviously results have been a bit disappointing basically under Crew's tenureship, and also there have been different arguments made. There's Funsmith and Terry Smith talking about GLP-1s and how they might impact on volumes for Diageo, and also that Gen Z are consuming less alcohol. And again, what does that mean for Diageo? The inference is it kind of now a tobacco kind of company that's in structural decline? My view would be that I don't think it is. I think there's a lot of growth ahead of it. I think we've talked about it when we've covered it before, but in terms of market share, it's still got huge way to go there. And I think with the quality of the brands that it has in its portfolio, whether that's Smirnoff, whether that's Captain Morgan's, Tanqueray, Gordon's, it's got really high quality brands. I mean, Guinness is another one, but I think particularly if you looked at the spirits, and also that they're doing zero spirit, they're doing more premium spirits. So on top of those kind of traditional brands, I still think it's got a long way to go, and I think the market is probably being too bearish on it with these more recent changes and arguably temporary trends. I think particularly with Gen Z, and at 15 times earnings to be able to buy a company of this quality at that price, I think is fantastic. I have topped up on it myself since the shares have been down, and I think probably if you get the right chief executive in, they will be able to realise the brands going forward. So that's my take. And I think in the meantime as well, you've got a pretty decent yield considering, what it used to be. And that was obviously related to sort of valuation that had become depressed and that yield hence going up. I would point out that they've had strong and consistent dividend growth too. Sam, what are your thoughts?
So I think this might be the first time we've covered it where I'm now a shareholder as well.
Yeah.
Yeah, I actually think, when you look at the share price performance, it all started to drop in Deborah Crew's reign. I think she's a bit unlucky in that in her first 6 months, she got a profit warning out. So the problems were already there. I think she's genuinely just been unlucky with the timing. That being said, she's had 2 years and it doesn't necessarily feel like she's kind of taken the business back onto the right track. So I don't think it's terrible, but I think she maybe has been a bit unfortunate, and she did have a very, very tough act to follow. In terms of valuation, yeah, I think at 15 times earnings, I think if you can find me a better business on the FTSE for 15 times earnings, I'd be very happy to buy it. Otherwise, I'll probably top up on Diageo at some
Yeah.
point.
No, absolutely. Okay, on to Cake Box Holdings, a debut on the show.
It is a debut, yes. So, have you seen the cake box stores, John?
I haven't actually, no.
I feel like I have seen. It's difficult because with these cakes, and I may be making an argument against it already, but I feel like with these cakes and sort of sweet ones, a lot of the brand they kind of look quite similar. But I'm sure I've seen it on like a high street. But anyway, keep an eye out now. But anyway, so Cake Box, for anyone who's not familiar with it, they have grown from a single concept store in 2008 to a franchise with over 250 locations today, and they are now the UK's largest retailer of fresh cream celebration cakes. They listed on the AIM in 2018, and they've highlighted they've got a why invest in us page on the website, but they've said they've got an asset light and cash generative model, which they're franchising, I would agree with. 6 years of strong growth in franchise sales and stores, and they've highlighted a significant market opportunity. So the sweet baked goods and celebration cakes market was 2.8 billion in 2022 and is forecast to grow to 3.2 billion by 2027. They are targeting 400 locations, so they're already at about 250. They're targeting to get to 400, and they have come out with their full year results. So revenue was up 13% to 42.8 million. Gross profit was up 12.6% to 22.46 million. EBITDA was up 1.5% to 7.8 million, and underlying EBITDA was up 17.1% to 8.73 million. Profit before tax was down 1.8% to 6.16 million, and the underlying profit before tax was up 17.4% to 7.08 million. Underlying basic earnings per share was up 19.4% to 13.18p, and the final dividend was up 11.5% to 6.8p a share. They've highlighted that the gross margin decreased marginally from 52.7 to 52.5 as the group absorbed certain input price increases through the financial period. The group's net debt position was 9 million, and that swung from net cash of 7.3 million, but this is due to the 22 million pound acquisition of Ambala Foods Limited. For anyone who's not familiar with Ambala Foods, they are a confectionery company established in 1965, which sells South Asian sweets and savoury snacks. So they do Asian desserts, and they have 22 stores in the UK, of which 19 are owned and 3 are franchised. I would think the plan with this is to do a similar thing where they might keep the own stores, but I think the intention was to grow it by franchising, like they have quite successfully for Cake Box themselves. They well, Cakebox have actually said that they plan to grow the online stores, expand into retail channels, leverage the existing network and expertise in franchising. They've identified up to 100 new locations where Ambala products or franchises could be integrated. I don't know if that's in their existing locations, so just kind of expand the product range. And they also expect to unlock at least £1 million in cost savings from combining the operations. They have highlighted that the total number of Cake Box franchise stores increased from 225 to 251, and they've entered new locations, including Belfast, Hastings, and Worthing. They've had 19% growth in online sales to 19.1 million, and that follows an increased investment in digital marketing and e-commerce capabilities. They launched a number of new products to capture latest trends, including an exclusive partnership with Ferrero UK to launch a Nutella range, and the popular Dubai chocolate range, designed specifically for Valentine's Day, Mother's Day, and Eid. Franchisee total turnover increased by 9.5% to 86.3 million. Like-for-like sales growth was 3% in the franchise stores, and the number of multi-site franchisees increased from 47 to 54, which is good. It's obviously going quite well for the franchisees. The current outlook is the trading in the 2026 year has started positively and in line with expectations. The integration of the Ambala acquisition is progressing well and on track to achieve identified cost savings and efficiencies. Whilst it remains a challenging consumer environment, they're well positioned for continued growth with an expanding store estate, growing customer loyalty, and increasing online sales. In fact, as well, if you look at how they've performed over the last 5 years, revenue's basically doubled from 22 to 43 million. Gross profit has doubled from 10.93 to 22.46 million. Operating margins decreased slightly from 19.3 to 15%. Operating profit has increased from 4.25 to 6.44 million. Net profit is up from 3.37 to 4.37. Earning per share, that's 0.09 to 0.12. If you look at the cash flow, the operating cash gone from 4.31 to 6.6. Look on the balance sheet. Balance sheet looks pretty healthy. This is the first time they've really had a decent amount of debt popping on, and that's because of the Ambala acquisition. I don't know what the individual figures are for Ambala, but I think if they can go and franchise that properly, that 22 million should be paid off pretty quickly anyway. In terms of the valuation, the business trades at a PE ratio of 14 and has a dividend yield of 5%. I kind of picked this because it just sounded a bit interesting, and I think I've seen the stores, and it was a relatively well. It was actually I picked it when we had a quiet week a few weeks ago, and then they delayed the earnings, but I still wanted to look at it. But yeah, I kind of assumed this was a company we'd never actually come back to, but I think it probably is good enough for the watch list. Actually, I'm quite impressed. I genuinely I would want to actually go and do a bit of market research. So I'd need to
Yeah.
go and actually try it and see what the store's like, because I think that would make it a lot easier to visualize it. But based on this, it actually looks like a decent little business. What do you think, John?
Yeah, no, likewise. I was quite impressed, actually. And I think it's not outrageously valued either, and probably got quite a lot of scope for growth ahead of it. I would agree with you. It's not something that, or an area of the market that I do know much about. And I think doing some market research with a bit of tasting as well would be quite helpful. The franchise model looks great,
So they've got one. They've got quite a few near me actually.
though.
See if they've got any near you. Well, they've got one in Oxford, so
All right. Well, go along.
we'll report back shortly. Right, shall we move on to Frasers Group?
Yes, no, absolutely. So Frasers had their full year results out last week, and it was funny actually. We were discussing Mulberry. We were joking about Mulberry, I would say, and sort of saying whether Frasers might be interested. So I did actually look into this a bit more, and it turns out that Frasers are actually the second largest shareholder with a 37% stake in Mulberry, and they actually tried to buy the group last year too. Anyway, with Frasers, group revenue fell by 7.4% to £4.9 billion, largely driven by a 14.8% drop in sales in the premium lifestyle division, which includes the luxury flannels chain and House of Fraser, and then the Frasers sort of department stores themselves. Sales at the core sports retail division, which includes Sports Direct and Evans Cycles, dropped by 7.2% to £2.7 billion during the period. Adjusted pre-tax profit rose by 2.8% to £560.2 million, up from £545 million the year prior, and reported pre-tax profit fell sharply by around 24% to £379.5 million, largely due to one-off charges. And if we look at some of those, so store closures from 44 to 29, and specifically they mentioned results from the game in Spain, which is now discontinued operations. So there's, I think, £6.3 million gain net of tax, which was excluded. And also, I think they excluded some hedges that they had, and also some of the positions in, I think, Hugo Boss, which are also down, and a fair value loss on equity derivatives of £36.1 million too. And in terms of retail gross margin, that improved by 170 basis points to 45.6%, and overall group margin rose by 150 basis points to 46.8%. And that was driven by right-sizing lower margin segments and shifting towards the higher margin areas. If we break the results down a little bit further, so UK sports retail we've mentioned, and then premium lifestyle we've also mentioned. In terms of international retail, so that was actually up 1.3% to just over £1 billion, with growth from Sports Direct International and Twin Sport acquisition, though trading profit fell by £13.1 million due to inflation and some of the acquisition costs. They've got some of the major brand tie-ups and strengthened their relationships with Nike, Adidas, Hugo Boss, and Murray. Interestingly, so this is Mike Ashley's son-in-law joined the Hugo Boss's supervisory board. and they've increased the holdings in, this is for good or for bad, but in ASOS, Boohoo, AO World and Mulberry. And the takeover bid we mentioned last year for Mulberry and the Boohoo board access were mixed at best. Guiding going forward, adjusted profit before tax is expected to be in the 550 to 600 million pound range. They'd mentioned headwinds and anticipate at least 50 million pounds in extra costs due to the increased business taxes in the UK, notably the national insurance from April's budget. And I think one of the statistics is that they have 32,000 staff. So they've got loads of staff at sort of the lower end, which obviously they're going to be particularly badly hit from that. Mitigation strategy, so they are emphasising AI, but I suppose isn't everyone. Margin control, cost streamlining, and continued rollout of the elevation strategy, with early full year 2026 trading described as encouraging. In terms of valuation, Sports Direct, but Frasers have a market cap of £3.1 billion, and they're trading at 7.4 times forward earnings, got net debt of £847 million, and they're not currently paying a dividend. It's certainly the cheapest it's been in a long time. Obviously, it's on the back of disappointing results. I think looking back, it seemed to have bottomed out at about 5.9 times forward earnings in February. I think it's very difficult to know what to make of things. I think at the core, they do have a good business in the form of Sports Direct. They've got some premium brands which have been underperforming recently. I don't think they're the premium brands at the end of the market as LVMH, but equally, I think they're probably some of them maybe a bit above Burberry. And I would probably back the Mike Ashley family to actually, turn this round. They definitely have some losers in the portfolio, but they didn't pay a lot for a lot of those losers, and they were in fairly distressed positions when they did take positions. I think it's an interesting prospect at just 7 times forward earnings in terms of a value investment. I would consider putting it on my watch list at the current price. Sam, what are your thoughts?
Sort of agree, actually. I was thinking as you're going through it that I know the revenue fall is disappointing, but when you look at the underlying profit, that's fallen by a lot less. So it kind of tells you that they've got rid of quite low quality revenue, and they are shutting unprofitable parts of the business. You kind of know as well. I know we have this ongoing joke that he just buys every high street company that gets into trouble, but there's going to be some hits and some misses, and you kind of have to accept that. So that being said, I don't think the strategy is terrible. I think, and as well, you're getting at this really quite low multiple of earnings. But then when you actually look at the other businesses it owns quite decent chunks of, now some of them might end up being zeros. Like, I'm not saying it will be, but Mulberry. In fact, actually, did they have an all right amount of cash? I can't remember.
Yeah, I think you thought they had a reasonable amount to keep them
Yeah,
going.
but it's not got to turn the business around. But and again, like Hugo Boss, I don't think it's in we've not really covered it, but just from a look at the share price, it's not doing amazingly well, but at the same time, the share price doesn't suggest that it's in real trouble. And from a quick read online, it kind of suggests that the reason they're buying so much Hugo Boss is partly just because they want to foster that relationship. But I guess the point is, as well as those earnings, you are actually getting quite a lot on the balance sheet. When you look at the debt, it's pretty small compared to the size of the company and the cash it generates. So, yeah, I think if someone was to buy it and make a value argument on, firstly, that the earnings are fairly decent quality, and as well, you're getting all the extra balance sheet value, I could kind of understand it. I just think, for me, I don't really want that retail exposure in the portfolio. That's not to say I think, I suppose if you do want retail exposure, there's few better operators than Mike Ashley and the family. But I would just rather steer clear of it, even though I agree with what you're saying. I think if someone were to make a case for it, I think it would be pretty sensible. But I think Boohoo might have just traumatized me a bit too much, which I would end up owning again via Frasers Group. And I've got no desire for that, which would then mean I'd end up inadvertently owning Debenhams for a third time, which again I don't want. So
Yeah. So
I think I'll stay
interestingly,
clear.
they are the largest single shareholder of Boohoo, and they have about an equity stake of about 22%. Interestingly, in terms of Hugo Boss, they own nearly 20% of Hugo Boss.
Yeah, surprisingly big. The only thing is with Hugo Boss, it says it's trying to foster relationships, but I think if you could start getting Hugo Boss in Sports Direct, I feel that would be dilutive of the quality.
But they would be, I suppose they would be arguing that you'd see it more in the flannels and the House of Fraser rather than
Yes.
the Sports
Yeah, fair
Direct.
point. Yeah, fair point.
And it's this, I guess it's this elevation strategy, which I know it's been a tough time in the last year or two, but I think it's probably the right way for them to go.
Yeah, I think if they can crack it with brands like Hugo Boss, then yeah, I think it'd be hard to argue with the results.
Yeah. Okay. Shall we move on to money?
Yes, so Mony Group, they were better known as Mony Supermarket, which is the biggest brand they have, but they rebranded about a year ago. They have come out with their half year results, and group revenue was up 1% to 225 million. Adjusted EBITDA was up 2% to 75 million. Profit after tax was up 3% to 45.6 million. Adjusted basic earnings per share was up 4% to 9.3p. Basic earnings per share was up 4% to 8.6p. Operating cash flow was down 16% to 43.7 million. Net debt improved by 27%. It's now down to 18.4 million. Dividend was up 1% to 3.3p. They've said that the revenue up 1% was against a strong prior period with anticipated headwinds in car offset by growth in other channels, underlying the strength in breadth. Adjusted EBITDA growth of 2% to 75 million, underpinned by the continued focus on cost control and greater automation. And they said the operating costs were down 6% and adjusted earnings per share grew 4%. They helped customers save an estimated 1.4 billion, although that is down from 1.7 billion a year ago. And they've delivered growth across the members' base propositions. Super Save Club surpassed the 1.5 million member mark, now generating 14% of group revenue. So this is quite a key part of the strategy. So they're trying to get more people on like a membership model. It's a free membership, but a membership model for doing this stuff, because at the minute a lot of the revenue is coming from like paid advertising. So they're trying to get like the cost per click down basically. And they've also enhanced provider services to continue to deliver profitable growth with revenue up to 11%. 96 million package of shareholder returns for 2025, including the ongoing £30 million share buyback and progressive dividend growth. If we look at it, the market cap is 1.1 billion, so 96 million returns for shareholders is a decent return. It's about 9%. They said our recent trading performance, coupled with momentum in our strategic execution, gives the board confidence we will deliver adjusted EBITDA for 2025 within our current published consensus. If we break down the results by division, insurance revenue was down 2% against a strong prior year, but within that, car insurance premiums were down 9%, and home insurance premiums remained in growth at 4%. They said to compensate for the headwinds in car, they've shifted the focus to other insurance categories with home, life, and travel performing well. Money delivered good growth of 4%, driven by strong activity in borrowing, underpinned by growth in credit cards and improving trend in personal loans. In banking, robust savings performance offset lower current account switching volumes. Home services grew 29%, albeit from a low base, both energy and broadband delivering significant growth over the period as the energy market continues to gradually recover. That would be very promising if that actually came back to the level it was at sort of 5 years ago. Cashback had a tougher period with revenue £3 million lower at 27 million, which is down 9%, reflecting the challenging retail environment along with the knock-on effects of the weaker car insurance markets on Quidco Compare. Travel was down 2% with continued high competition in car hire, partially offset by solid performance in package holidays. Note that travel insurance is included within the insurance segment. Going back on Super Save Club, that was launched in 2023, and since then they've actively built out the proposition, adding nearly all of their key products, with the club now covering more than 95% of products sold by volume. Super Save Club offers customers a cash reward of up to £20 for every purchase, with customers able to earn up to £130 each year, a best price guarantee, and a simple and easy customer interaction, which allows them to skip lengthy application forms. With over 1.5 million members, we can see consistency and trends as we build out the member base. In short, the club is achieving what we'd hoped. When we compare it with the baseline traditional users, you see 40% more customers are coming to us directly for their second purchase. Members are then buying more from us with a 3x increase in renewals and a 3x increase in second purchases. And these members also more engaged with a 2x increase in their propensity to interact with customer relationship management and a 4x increase in the take-up of the MSM app. In terms of the marketing margin, that has dropped from 60% to 57%. You would hope that drop will continue with the Super Save Club. Net Promoter Score, that's at 172. MSM and Quidco active users was down from 14.3 to 13 million, and the revenue per active user was up from £18.24 to £19.83. In terms of the valuation, the business trades at a PE of just under 13 and a price to free cash flow of 10. It has a dividend yield of just over 6%. I am a shareholder of Mony Group. I'm a pretty happy shareholder. The shares were down about 7% following the announcement of these results. I think the car insurance was disappointing, but also unsurprising. I actually think there's quite a lot to like in there. I think the drop in revenue is also the drop in customer savings is also disappointing and customer numbers. But I think the strategy of switching away from that pay-per-click model to the Super Save Club, I think it's the right one, and I think it might need a couple of years to bear fruit, but I think that could make it into a much more efficient business if they're able to crack that. And it looks really promising so far. I think generally there's also quite a lot to be optimistic about. I think it seems like the energy market might be coming back to life a bit, so that would be a nice bonus because that used to contribute like 20% of the revenue, and it basically just disappeared. If that came back, that would be fantastic. But just generally, I really like the way this company is run. I think management have been very smart. It's always been very well diversified. When the energy market dropped off, they bought Quidco, which was a really smart acquisition. I think the move away from pay-per-click to Super Save Club, I think that's good as well. So it's a company I'm quite happy to trust with my money in as well. It is distributing a lot of cash back to shareholders as well. That yield of like 9%, including the buybacks, is just ridiculous. So yeah, I'm very happy with it despite the market reaction. What do you think, John?
Yeah, I think it's one that's growing on me. I was concerned in the last couple of years when the energy just went off essentially completely, but I think the group handled that very, very well. And during the cost of living crisis, buying Quidco, I mean, it made complete sense, and they've done remarkably well despite a lot of those headwinds. I think even whilst growth may be limited, I think actually in terms of value, there's probably a lot to be said. I'm quite interested in it now, and it's probably going on the watch list.
Oh, wow, this is quite a big moment.
Out of interest, what price did you get into Mony Group at?
I'm basically at break even, but
Okay.
I've had some decent dividends as well. So I'm probably up like 5%, including the actual dividend. But
Yeah.
it's basically the same price I bought in at, I think.
Does it make up a decent position in your portfolio, or not really?
I've got 4 or 5 that are pretty all similar size.
Yeah.
The 4 or 5 biggest, but yeah, it is one of the biggest ones. I didn't intend for it to get that big actually, but I think I had some cash. I couldn't really decide what to do with it, and that happened a couple of times. And I just ended up looking at, well, I quite like the money valuation. It hasn't really changed. I'm happy with the dividends.
Yeah.
It's been up and down a lot. Like I used to own it previously as well, but it's been, over the years where I've had it, it's been as low as kind of sort of in the £1.70 region.
Yeah.
It's been as high as like I think £3, and there's never really a point where it's been at any of those levels where I felt like really uncomfortable holding it. So I just think it just ended up growing basically because of that. But I didn't intend to make it such a big position. It's just kind of happened.
No, fair enough.
Right, should we move on to Verizon? A debut on the show.
It is. So yeah, final company of the week, and it is a debut. I suppose it's more as we didn't have another US company of the week, and earnings just slowed down a bit, although they are going to pick up again. So Verizon, for anybody who doesn't know, sorry, I'm just going to get the article up. I've lost it. So Verizon, for anybody who doesn't know, is the largest mobile network in the US, and it's the world's second largest, second only to China Mobile. In terms of its results, so it's had its second quarter results out, and group revenue was up 5.2% to $34.5 billion, and that was against 33.7 expected. And within that, wireless service revenue was up 2.2% to $20.9 billion. Underlying cash profit, EBITDA, rose by 4.1% to $12.8 billion, and price hikes over the quarter contributed positively towards performance, but as a result, consumer postpaid phone subscribers fell by 51,000. Free cash flow over the first half rose by 3.6% to $8.8 billion, driven by higher profits and lower capital expenditure. Net unsecured debt totaled $116 billion and $6.8 billion improvement on the same time last year. For 2025, wireless service revenue is expected to grow between 2 and 2.8%, with underlying cash profit growth of between 2.5% and 3.5%. Previously, it had been guided at 2 to 3.5%. And shares were up around 5% in pre-market trading. In terms of valuation, the group has a market cap of $172 billion and trades at 8.6 times forward earnings compared to the 10-year average of 10.7, and it has a prospective dividend yield of 6.8%. I thought these results were okay. I don't think Verizon, for me, is particularly exciting. I think it's one of those mature telecoms businesses that sees a lot of its growth behind it. It has high capital expenditure, and it does have a lot of debt. It did take over or acquire Frontier Communications, which has some fibre infrastructure. For me, I've got Airtel Africa in my portfolio, and I'm not, remotely comparing Verizon with a minnow like Airtel Africa. But I think the attraction with Airtel Africa is that it's rapidly growing, it's in an emerging market. Yes, it's inherently more risky. However, I think, a mature business like this with high capital expenditure and I would argue not a huge amount of growth ahead of it, it's a bit of a turn off. Yes, it's not expensive and you could make a value argument and that it's sort of got a decent dividend there, but it's not one for me. Sam, what are your thoughts on Verizon?
I think it's preempted a lot of my comments, but the argument I was going to make is that the dividend's pretty decent. I know you covered that, but 6.38% I think is pretty good. And when you look at the dividend, it's historically been fairly well covered by the cash the business generates. Yeah, so if we go through the dividend cover, it was 1.55x in 2024. The year before that, it was 1.05x. So then the year before that, it was 1.96. Year before that, 2.1. Year before that, 1.74. So it's historically been a well-covered dividend. The company is still growing, albeit small. So it doesn't look like there's anything that would put that dividend under pressure. That being said, I can get that yield from other companies I'd prefer to own. I can get it from some of probably the REITs. I'd rather own those for a 6% yield. Money Supermarket, which we've just covered. I mean, even something like cbox with a 5%, you think that has, if they hit their target of 400 stores, that's got pretty decent potential for capital growth as well. So I think as an income play, it's not terrible, but I think we are just in an environment now where for a 6% yield, you can actually get a decent amount for your money. So I just would never pick Verizon.
Fair enough. Okay, of the companies this week then, what would be your first pick and what would be last?
I think first pick, I think is fairly easy. I think I'd probably have to go with Diageo. I think Mony Group I like, and I like the valuation, but I just think Diageo at 15 times earnings, I just think it's a really, really great opportunity, and I think it's something that historically we haven't seen on the show before. So yeah, I think Diageo it kind of has to be. I do think cbox Holdings looks very interesting as well, albeit a very different type of business. Last pick, I think I'd probably go with Halma. It's a pretty good business, but it just doesn't interest me. What about you?
I would go Diageo on the basis of the valuation. I think it's a great company, but at 15 times earnings, it's cheap. I mean, it's the cheapest we've seen it. And you wonder how often you're going to get a business like that you can own this cheaply. So it would have to be that without doubt. But then close second, I'd say cbox Holdings, and I think Mony for me is also attractive. And then, Frasers, that's sort of a bit of an outsider there, but in terms of valuation, it certainly looks cheap. And then last, I would probably go Verizon. I think Halma perhaps has a bit more growth ahead of it. It is more expensive, but Verizon I really don't have interest in, so that will be last for me.
Right, I think that's everything in that case.
Thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.